Warren Buffett, the Oracle of Omaha, is one of the most successful investors of all time. He built his fortune by following a simple yet powerful investment philosophy. Buffett's approach centers on long-term thinking, value investing, and a deep understanding of businesses. His disciplined approach led him to build Berkshire Hathaway into a financial powerhouse. He focuses on identifying undervalued companies with strong fundamentals and holding them for the long term. Warren Buffett's investment philosophy hinges on the power of long-term thinking. He believes in holding on to investments for extended periods, allowing the magic of compounding to work its wonders. This approach contrasts sharply with the short-term speculation that dominates much of the financial world. Buffett often compares investing to planting a tree. You carefully select a healthy sapling with strong roots, knowing it takes time to grow into a mighty oak. Similarly, investing in a well-chosen company requires patience and a long-term perspective. Short-term market fluctuations are like the changing seasons, affecting the tree's immediate appearance but not its underlying strength. Trying to time the market by buying low and selling high is often futile and can be detrimental to long-term returns. Instead, Buffett advocates for identifying undervalued companies with solid fundamentals and holding on to them, allowing the company's intrinsic value to appreciate over time. This long-term approach minimizes transaction costs and allows the power of compounding to work its magic. One of Buffett's most fundamental principles is investing only in what you understand. He calls this staying within your circle of competence. This means focusing on industries and businesses you know well, where you can confidently assess their long-term prospects. Buffett avoids investing in complex or trendy businesses he doesn't fully grasp. He sticks to companies with simple, understandable business models, making it easier to evaluate their competitive advantages and future earnings potential. For example, Buffett famously avoided investing in technology companies during the dot-com boom, despite their soaring valuations. He didn't understand their business models or the rapidly evolving technology landscape. This decision proved wise as many of those high-flying tech stocks crashed when the bubble burst. Investors should focus on industries and businesses they understand, whether it's retail, consumer goods, or healthcare. Knowing the ins and outs of a particular sector allows for more informed investment decisions. Value investing is at the heart of Warren Buffett's investment strategy. It involves identifying undervalued companies whose intrinsic worth is higher than their current market price. These companies may be overlooked or temporarily out of favor with the market, creating opportunities for astute investors. Buffett seeks companies with strong fundamentals such as consistent earnings, low debt levels, and competent management. He looks for businesses with a margin of safety, meaning their intrinsic value significantly exceeds their market price, providing a cushion against potential losses. Finding these undervalued gems requires thorough research and analysis. Investors need to delve into financial statements, understand industry trends, and assess the company's competitive landscape. Value investing is not about chasing the latest hot stock or following the crowd. It's about identifying solid businesses with long-term potential that the market has undervalued. This patient and disciplined approach can yield significant returns over time. Section 5. The Snowball Effect: Compound Interest and Reinvestment. Warren Buffett often refers to the power of compound interest as the eighth wonder of the world. It's the snowball effect of earning interest on your initial investment and then earning interest on your accumulated interest. Over long periods, compound interest can turn small investments into significant wealth. The key is to start early and reinvest your earnings, allowing your money to grow exponentially. Buffett's investment strategy emphasizes reinvesting dividends, further accelerating the compounding process. When you reinvest dividends, you purchase more shares of the company, which generate even more dividends in the future. This continuous cycle of reinvestment creates a powerful snowball effect, compounding your returns year after year. The longer you stay invested, the more potent the impact of compound interest becomes. It's a testament to the power of patience and long-term thinking in building wealth. Section 6. Building a moat: Identifying sustainable competitive advantages. Warren Buffett seeks companies with a durable competitive advantage, which he calls a moat. A moat protects a company from competitors, allowing it to maintain higher profits and market share over the long term. A moat can take many forms, such as a strong brand reputation, a loyal customer base, a cost advantage, or proprietary technology. The key is identifying companies with sustainable competitive advantages that are difficult for competitors to replicate. For example, Coca-Cola's global brand recognition and vast distribution network create a formidable moat. Apple's innovative products, loyal customer base, and powerful brand create a significant competitive advantage in the tech industry. When evaluating a company, investors should consider the strength and sustainability of its competitive moat. Companies with wide and durable moats are better positioned to withstand competition and generate consistent profits over time. Section 7. Be greedy when others are fearful. Contrarian investing. Warren Buffett is known for his contrarian investment approach, which involves going against the herd mentality of the market. He believes in buying when others are fearful and selling when others are greedy. Market downturns and periods of panic can create opportunities for savvy investors. When fear grips the market, stock prices often fall indiscriminately, even for fundamentally sound companies. Buffett sees these moments as a chance to buy undervalued assets at bargain prices. Conversely, when markets are euphoric and prices are soaring, Buffett cautions against getting caught up in the hype. He reminds investors that excessive greed can lead to irrational exuberance and inflated asset bubbles. Contrarian investing requires a strong stomach and a contrarian mindset. It's about staying rational and objective when others are emotional, recognizing that market sentiment can swing too far in either direction. Section 8. Diversification versus concentration, finding the right balance. While diversification is often touted as a key risk management tool, Warren Buffett takes a more nuanced approach. He believes in concentrating investments in a select few companies that he understands well and believes have significant long-term potential. Buffett argues that excessive diversification can dilute returns and make it challenging to track and manage numerous investments effectively. Instead, he advocates for focusing on a concentrated portfolio of high-conviction bets. However, concentration doesn't mean putting all your eggs in one basket. Buffett still diversifies across different industries and sectors to mitigate risk. He carefully selects companies with strong moats and long-term growth potential, ensuring his portfolio is not overly dependent on any single investment. Finding the right balance between diversification and concentration is crucial. It requires careful consideration of your risk tolerance, investment goals, and the depth of your research and understanding of the companies you invest in. Section 9. Patience and discipline. The keys to long-term success. Warren Buffett's investment philosophy emphasizes the importance of patience and discipline. He believes that successful investing is a marathon, not a sprint, requiring a long-term perspective and the ability to resist emotional decision-making. Patience means staying committed to your investment strategy, even when the market is volatile, and your investments are not performing as expected. It's about trusting in your research and the underlying fundamentals of the companies you own. Discipline involves sticking to your investment plan and avoiding impulsive decisions based on market noise or short-term fluctuations. It means resisting the urge to chase the latest hot stock or panic selling during market downturns. Patience and discipline are essential for long-term investment success. By staying focused on your goals, ignoring the noise, and making rational decisions, you can weather market storms and achieve your financial aspirations. The Buffett Formula, a recipe for investment success. Buffett's philosophy provides a roadmap to build wealth steadily. Follow core principles consistently, not complex instruments. Think long-term, invest in companies you believe in. Stick to industries you understand. Identify undervalued companies with strong fundamentals. Seek companies with durable competitive advantages. Be contrarian. Buy when others are fearful. Stay patient and disciplined. Section 11. Conclusion. Building wealth the Warren Buffett way. Warren Buffett's investment success is a testament to the power of simplicity, discipline, and a long-term perspective. His principles have resonated with investors worldwide, demonstrating that building wealth is achievable for anyone willing to learn, invest wisely, and be patient. The Buffett Formula is not about getting rich-quick schemes or complex financial strategies. It's about investing in quality companies, holding them for the long term, and letting the power of compounding work its magic. By embracing Buffett's principles of long-term thinking, value investing, and staying within your circle of competence, investors can navigate the complexities of the market and build a solid foundation for financial success. Remember, investing is a marathon, not a sprint, and slow and steady wins the race.